So the paper is the determinants of hedge fund internal controls and fees. In particular, what we're examining in this voluntary setting, unlike mutual funds where everything's predetermined, why do some hedge funds choose particular internal controls versus others who don't? And what we find is there are several economic determinants for why in this voluntary setting that would happen. So some examples. Those that are short sellers, for example, are less likely to use internal controls where there's oversight. You think about why would that be? Well, one explanation is short squeezing, in that if you know the positions of a hedge fund who is in a short position, you could actually take advantage of that. So you think for these particular hedge funds, they want to go out of their way to ensure there's less oversight for these particular issues. Other examples relate to the use of better qualified auditors, more reputable administrators, and also the types of pricing mechanisms that they use to value the assets. We observe that for offshore funds, the offshore funds are actually more likely to have better internal controls than what the onshore US funds are. And one explanation for that is that the cost or expense for investors to actually recoup monies should something bad happen is probably harder to do in an offshore setting. So these funds in turn show that they have better internal controls so that it's less likely for this to occur down the track. Another very important result relates to younger funds generally having better internal controls than older funds. And this is slightly counterintuitive, but the main reason is if you think that you are a new fund, it's harder to reveal that you're a high quality type. And so what you do is you say, I'm a high quality type, I'm going to put a lot more oversight in my actions, therefore you can trust me when you invest your money in our particular hedge fund. Older established funds are very established, that they've proven and have a track record, so they don't have to necessarily go through these particular mechanisms. So that shows that in a voluntary setting where you don't have any requirements, investors get to choose whether they invest in funds, hedge funds get to choose what internal controls they have, the people actually think about the voluntary choice and that it matters quite a bit. Then it's a case of what could this affect? And it can affect two things. One thing is it can affect the fees. So what we find is that those funds that have stronger internal controls, such as how they price assets, controlling for everything else, tend to have higher performance-based fees. So often we think about the expression 2 and 20. The 20 represents the bonus or the compensation they get above sort of the zero returns. For funds that have better internal controls, this magnitude is greater, and for those that have weaker returns, it's lower. So what that suggests is that investors realize that given some funds have better or worse internal controls, this actually matters in terms of how they reward the managers down the track. We also find some limited evidence in terms of the types of internal controls that hedge funds employ and how that affects future fraud. And we think this is very important moving forward. Obviously the sample's very small, but we notice that those funds that have the manager involved in the calculation and the reporting of the net asset value, which is the primary number that investors use to determine what the value of their assets are, is associated with a greater likelihood of fraud. So if you get the manager involved, this is a less independent, less objective approach than, say, just getting a third party to do it. The likelihood of fraud is substantially greater. So I think that's a very important result too. Well, that's a very good question, although when you look now at empirical evidence, given that we've had many frauds over the past few years, there are some common factors related to these, and they primarily relate to the use of a custodian, the fact that there is the manager involved in this calculation of the NAV statement. So now that we know a lot more about why certain frauds occur, maybe that will prevent it. Of course, in this unregulated setting, unlike mutual funds, there are a lot of protections that are regulated in place, which cost the hedge funds and the investors money to set up. In settings like the hedge funds where you don't have to do that, it's completely up to the discretion of the investor. I think looking forward, moving forward, I think that investors are going to think very carefully in terms of which funds they invest in based on the strength of the internal controls. And talking to a lot of institutional investors, they already, many years ago, had decided not to invest in particular funds because they thought the internal controls were not strong enough, even given the quality of the hedge fund manager moving forward. I think first for regulators, we're talking about a period right now where we want to protect investors to a greater extent than what we've currently done. Now, to the extent that the investors are not aware that certain internal controls matter, our research actually suggests that investors do notice, and they take this into account when they determine the types of fees that they decide to charge in conjunction with the hedge fund manager. So it's not as if these sophisticated investors don't know what's going on, because I think they do. One also implication of the research relates to the incidence of fraud and things like that, and we're seeing at the moment particular types of internal controls being forced maybe upon hedge funds, which will reduce the likelihood of fraud. The results, if we know that certain internal controls prevent fraud, there's no reason why a sophisticated investor would choose to invest or not to invest in a particular fund, given they know that certain internal controls matter. Now, whether we want to spend a lot of government resources to protect investors, even given we know all this empirical evidence which suggests that some internal controls matter, well, that's a case on sort of where in policy you sit. So I'll leave that open. But finally, for hedge fund managers, I think it just confirms what they know, that investors do take all these things into consideration. And the choice of implementing internal controls is costly, both from an explicit cost, in terms of your choice of auditor or getting a third-party valuer to come in, and they have to be traded off against the benefits, such as do you get higher fees, or does this oversight allow certain investors who may otherwise wouldn't have invested in the firm to now invest in you. So I think that as this research and other accompanying research is coming out, it's not necessarily clear that by regulating you're going to solve the problems, but what certainly is clear is some internal controls do matter, and the choice of internal controls is something that we can explain through economic determinants.